Latest CPI print in Canada this morning, 2.9% year over year for the month of January. Comparatively, it's lower than what we saw in December. In December, it was 3.4%. Much different, right? Much different. Big delta on the downward side. And the economists, the mainstream economists, are saying that's a good sign, guys, because now finally we have this inflation genie back in the Bank of Canada's targeted range between 1 and 3%. Okay, but it's just one reading, guys. It is just one reading. Like the same economists were disappointed last month when we saw 3.4% in December, right? They were saying it's unfavorable, but the same economists now are singing a happy song somehow. So what changed? Basically, the Canadians are struggling with their purchasing power. So higher interest payments on the credit cards or auto loan or mortgages is crushing the purchasing power. Okay, so if you have seen on average your interest payments on the mortgage or car loan or credit card debt has gone up by $1,500 or $200 per month, that's a big monthly deficit. Right? So of course, when you see your expenses have gone up like this, you will start cutting spending on the other side of the equation. That's really what's happening. So the Canadians are struggling with the purchasing power. They're slowing down their spending in other discretionary items. Okay, whether this is vacation or dining out or purchasing home furnishing, stuff like furniture and all that stuff. So we are seeing like Canadian Tire, they published their earning report last week, and they clearly said they're seeing a massive slowdown in the consumer spending, and we are now seeing this in the CPI data as well. So when we look at under the hood, the CPI data, pretty much everything kind of came down except shelter. Shelter is still going up, and it is 6.2%. Okay, in December it was 6%. So shelter costs still going up, and it's not going to come down, guys. It's not going to come down anytime soon. Let's assume if Bank of Canada starts cutting a rate like March next month. Okay, so they won't cut like 1% all of a sudden. They will start cutting slowly and bit by bit, like 25 basis points, maybe in April, and then take a pause, and then 25% 2 months after. So they're not going to cut drastically unless we see the stuff hits the fan for some sort of a crisis. I'm not seeing them cutting rates aggressively. And to be honest, even if they do, I don't see any major impact on the mortgage payments. The fixed rate mortgages, they follow bond market. And arguably, the variable interest mortgages are also kind of follow the debt market. Yes, it is fluctuating based upon the prime rate, but it all depends upon the risks and the future growth and inflation expectations. So banks will always see what's happening further down the road in terms of the future expectation, and that's how they determine the lending rate. So I don't see the shelter inflation coming down very soon, guys, okay? Because the shelter component has rents as well as the mortgage payment. Here's the key thing. If you have been my follower, I've been telling you guys that the main reason we have inflation in this country is because the government is too big. What I mean by that is the government is spending like a drunken sailor. If you look at their fiscal budget, okay, they have been constantly running fiscal deficit year over year over year over year. Okay, that fiscal budget has gone crazy during pandemic. It is now coming down, but it's not coming down drastically. It is coming down very, very slowly. And if you look at this chart, that shows you the projection going all the way to 2027, 2028. So even in the next, let's say 5 years, we're not seeing that deficit balancing itself out, as Trudeau said. The budget will balance itself out. It's not clearly. And when you have big governments like federal government or provincial government, when they run fiscal deficit, you're actually quote unquote printing money. When you run deficits, you're borrowing money from the public. Okay, public means debt market, bond market. Okay, when you borrow money, it is lent into the existence. So those new dollars are injected in the economy. Okay, Bank of Canada doesn't print money. It's the banking system that does that. When the federal government or provincial government, when they borrow money, they issue bonds, and those bonds are purchased by the market participants like banks and financial institutions and foreign entities. And when they do that, those newly printed dollars are injected in the economy, and that drives the inflation. This is one of the main reasons why we're seeing inflation. So unless the government, both federal and provincial, they balance it out, we don't see inflation coming down to zero. Okay, so even if it is 2.9% now, it can go up again. It all depends upon the supply and demand side of the equation. And who's going to pay for those budget deficits? It's Canadians in the form of taxes. So when your provincial and federal government run deficits, they're borrowing money and they pay interest on that. So you know that how much interest the federal government is paying right now on an annualized basis? It's $46.5 billion. And comparatively, to put it into context, it is higher than the government spent on childcare benefits. And it's close to what the government spent on healthcare transfer. That's how big is the interest cost just on the debt, just on the deficit side. And if you look at it from the provincial lens perspective, the provincial government is also running deficits, so they're also paying interest on that, and their interest payment is higher than that they pay on post-secondary education. And total cost of interest, combining federal and provincial, is actually close to what they spend on K-12 education. So that's the interest cost, guys, just interest cost, no principal, just interest cost that the government is paying, and that will be paid by you and I in the form of taxes. So get ready for higher taxes going forward, because the government is too big. They're spending a lot of money like drunken sailor, and that extra spending is going to be financed by us Canadians in the form of taxes. So I don't see this is getting fixed anytime soon, even if the government is changed. If Pierre Poilievre came into the power, how is going to finance this deficit? Austerity? That will be his political suicide. So when he say axe the tax, how is he going to fund that deficit? That will be my question. And the only way to do that is borrow more money. When you borrow more money, you're going to pay more interest payments, another burden on the taxpayers. Unless you take an austerity route, which will be a bad political move. In the long, it's going to be good for Canadians, but it will be a bad political move for Pierre Poilievre. Anyway, we'll see. If you have any questions, put your comments down below. If you like this video, give me a thumbs up and subscribe, and I'll see you in my next video. Take care.